With the tech sector taking a direct hit in the bear market, can Intel recover and regain their former glory? Holy banana bread, let's do this! The bear market has been a very rough ride for the Nasdaq, and in 2022 alone, the index has fallen by 29.40%. The Nasdaq, of course, is the home of most of the big tech companies in America, which, well, yeah, it includes Intel. We will find out a little later whether Intel has come in better or worse than that Nasdaq average. Before we get our tech on, tell me in the comments if you have any tech stocks in your portfolio. I am always grateful when you drop in on the home of free financial content on YouTube. While you are here, please subscribe as you don't want to miss a single moment, and a huge thank you for that click. Intel began all the way back in 1968 in Mountain View, California. The name comes from the words integrated electronics. Initially, they were a company working on logic circuits and magnetic memory products. By 1971, they had produced the world's first microprocessor. Of course, as computers became more and more central, Intel had found their niche, and that demand for their products, well, it grew. With the eventual personal computer becoming mainstream, Intel became the most recognized chip manufacturer in the world. They did have competition from other chip manufacturers, such as AMD, but they held the market dominance, though that dominance was going to get reduced somewhat. Intel would of course see more of that dominance erode in the future as Apple moved away from Intel's processors and AMD's popularity continued to grow. Intel also had development issues, but have been striving to get themselves back on track. There has also been supply chain issues that will hopefully be, well, less of a factor going forward, and let's face it, those supply chain issues are affecting all chip manufacturers, not just Intel. They still provide those chips for most PC manufacturers, and as a result, they do still hold a lot of customer loyalty. They do have plans for factory expansions into Ohio and also Germany in a partnership with Brookfield Asset Management. That does sound pretty good, but of course, you guys know me, I need to see the math. When we start with a little surface data, Intel has a market cap of $122.12 billion, which makes them a large cap company. However, they had a market cap of $209 billion before the bear market, which made them at that time a mega cap company. Their beta comes in at 0.73, which makes them less volatile than the market average. Their earnings per share come in at 3.23, and they have no significant dilution. Their earnings are forecast to grow by 6.43% per year, which is great. This is something I do like to see when I assign a little bit of value to a stock. They have a price to earnings ratio of 9.00, which is fantastic, as the average PE ratio amongst chip companies is 23.20. Their price to book ratio comes in at 1.20, which is pretty good as well, because that means they are only valued 1.2 times over their book value. Interestingly enough, if we look at their fair value via a discounted cash flow model, it comes in at $21.77. They are currently priced at $28.94, so that means they are overpriced by roughly 32.9%. Normally this could be a concern, but yet I think it is going to work itself out. As I mentioned earlier, they are forecast to grow 6.4% per year, while the industry is forecast to grow 13.4%. I believe the reduced growth compared to the industry will be a factor that helps that fair value get back in line. Intel does have a dividend, and their yield is 5.045%, which is paid out quarterly in the amount of 36.5 cents USD per share. Their payout ratio comes in at 44.66%. Their dividend is well covered by their total earnings. However, one concern is that they have a leveled cash flow of negative $5.99 billion. A leveled cash flow is what is left after their earnings pay off all of their expenses. Even though their dividend has been very stable for the last 10 years, I would still be a little concerned if they do not improve the cash flow situation. At the start of 2021, Intel was listed at $49.33, and by the end of that year, they were up to $52.16 for a return of investment of 5.74%. Factoring in their dividend, we're looking at a total return in 2021 of 10.78%. Here it comes. Enter the bear market. In 2022, Intel stock fell from $52.16 all the way down to $29.59 for an ROI of negative 43.27%. Holy friggin' banana bread, that's a little bit on the steep side. Even if we add in those dividends, you are still down 37.54% compared to the Nasdaq's 29.40%. Yes, Intel did much worse than the Nasdaq. Yikes. Okay, let's take a look at their debt and see how they fare in that department. Intel has a total debt of $28.142 billion. They also have $70.047 billion in equity. This means that their debt to equity ratio comes in at 40.2%, which is absolutely not too bad. If we break that debt down a little bit more, we'll see that in the short term, they have $42.26 billion in assets compared to $27.81 billion in short-term liabilities. When we switch to long-term, their long-term assets are $125.58 billion compared to $47.14 billion in liabilities. Their assets easily cover their liabilities. In fact, their short-term assets even cover their long-term liabilities, which is something I do like to see. Their debt situation is really not that bad. In fact, they could still be good taking on a little more debt, which bodes well for their cash flow issues. So what is the final verdict? Intel has, without a doubt, been ravaged by the bear market, but despite all of that, they still have overall okay fundamentals. This is a company that will survive the bear market and should recover on the other side. Well, that's kind of the definition of a blue chip, isn't it? If you are looking for a short-term prospect, it is not yet time to jump into Intel, as there may be a little bit of pain still left ahead. However, for the long-term investor, this one looks good, and long-term, there is room for a lot of growth with a not too shabby dividend. I see Intel as a good total return stock in the future. The fun does not have to end here. Check out my video on diversified royalty that I will link on the left. Otherwise, check out the video on the right that YouTube thinks you will like. Your click will decide who is right, and I will see you in the next video.